Hi, my name is Oluwaseyi Adeosun from ARM Investment Managers, and I'll be taking you through macroeconomic and financial market updates for July 2021. Headline inflation declined for the third consecutive month in June to 17.75%. But guess what? Despite the decline, headline inflation remains at its highest level since February 2017. The moderation was driven by the 45 basis point decline in food inflation, which closed at 21.83%, while core inflation declined by 6 basis points for the first time this year to 13.09%. The moderation in food inflation has primarily been due to base effects, as well as the reduced effect of the pandemic-induced shocks. Also, core inflation eased on the back of a reduction in prices of housing, water, electricity, gas, and other fuels index. The CBN'S Monetary Policy Committee held its 137th meeting in July, wherein it resolved to hold the monetary policy rate and all other policy parameters constant to enable the continued permeation of current policy measures in supporting the growth and macroeconomic stability. In addition, the CBN stated that it will no longer sell foreign exchange and issue new licenses to bureau de change operators. The aim of this move by the Apex Bank is to rein in on speculative demand for the currency and ensure that genuine demands are met. The equities market closed positive in July, after 2 consecutive months of recording losses. The market recorded a performance of 1.69% in July, while the year-to-date performance remains at a loss of 4.28%. The market scene was largely dominated by domestic investors, with the foreign players largely on the sidelines. Market activity picked up during the month as investors reacted to the impressive half-year financial results released within the month. July's performance was driven by gains in the oil and gas, industrial goods, and banking indices, despite losses recorded by the insurance and consumer goods indices respectively. Specifically, the market's performance was on the back of gains recorded in Danksem, Seplat, Access, WAPCO, and Zenith Bank stocks. The fixed income market maintained bullish sentiments in July. The money market rate indicators, open buyback, and the overnight rates declined by about 4% to 12.7% and 13.2% respectively, mirroring improved liquidity within the financial system in July. The improved liquidity within the system was on the back of the July 2021 bond maturity, estimated at about 561 billion, bond coupons, maturities from NTB and OMO instruments that came into the financial system within the month. In the Treasury bills market, subscriptions remained strong at the NTB auctions held during the month, as top rates on the 364-day paper declined by 120 basis points to close at 8.2%. However, secondary market average rate on Treasury bills increased by about 10 basis points to 6.63%, driven by about 50 basis point increase in yields on the short to mid-tenor Treasury bills, as some investors sought to exit positions. In the federal government bond market, average yields at secondary market declined by 46 basis points to 11.65 as demand rose for the instruments. At the monthly bond auction, the DMO introduced 2 new bond maturities, 2028 and 2036, which both closed at 12.35 and 13.15% respectively. However, stop rates on the 2050 bond maturity declined by 45 basis points to 13.25 as subscription at the auction was strong at 1.9 times the offer size. Now you may ask me, what are our expectations for the new month? For the equities market, we expect the market to trade sideways, with pockets of investors reacting positively to companies, especially banks, set to release their audited half-year financial results in August and likely declare interim dividends. Also, we expect the retail players to dominate market activity as investors remain cautious while taking a cue from the direction of fixed income yields. However, as inflation remains elevated with continuous supply from the federal government, coupled with lower maturity profile, the demand seen in June is expected to dissipate, consequently leading to improved yield levels as we move into the rest of the year. A quick recap of what we've discussed so far. Inflation declined for the third consecutive month. The MPC retained the MPR at 11.5% and held all other monetary policy parameters constant. The equity market recorded a gain after 2 consecutive months of recording losses, and the fixed income market recorded strong demand yet again, which led to a slight moderation in yields. I hope you found this insightful. Should you have any questions or comments, do not hesitate to contact us via our customer care representatives or your relationship managers. Remember, we remain invested in your tomorrow.